For the first time in years, the world's attention isn't on Washington or Beijing. It's on Tokyo. Something unusual is brewing in Japan. Something that could rattle global currencies, jolt bond markets, and possibly break a 50-year streak for the U.S. dollar. The yen, after years of sliding, is suddenly climbing. And the Bank of Japan, the most cautious central bank you can think of, might be preparing to do the unthinkable: raise interest rates again. I've uploaded 2 videos recently on Japan's bond market and how Japan's massive debt-to-GDP ratio feeds into the global economy. Today on Geo9, we're zeroing in on one thing: the dollar versus the yen. To see why Japan is shaking global markets, we need to rewind a bit. Back in early October, the yen went into free fall after Saita Kaiichi won the leadership race for the ruling LDP. She's known for following Shinzo Abe's economic formula: low rates, heavy stimulus, and an export-powered model. The coalition split almost instantly. The centrist party pulled its support, refusing to back her hawkish foreign policy stance and conservative social views. Even so, Takaichi gathered enough support from smaller right-wing groups. She became prime minister on October 21st, and that's when the storm hit. Markets reacted immediately. The yen fell again, dropping to levels not seen since January. But then the plot twisted. Her own economic advisor, now Japan's chief economist, hinted that she might actually allow a rate hike, just one, a 25 basis point bump sometime before 2027. That was the plan at first. Originally, traders expected a January move, but the calendar is shifting fast. Now, markets see a real chance of a hike in December at the BoJ's meeting on the 18th and 19th. The yen started moving ahead of time. Just 2 weeks ago, it touched 154 per dollar, a shockingly weak level. Then, momentum flipped. The currency surged to 154 per dollar, gaining more than 2% in under 48 hours. Even now, it's far from normal. Historically, the yen hovers around 110 to the dollar. After years of decline, any upward move is a big deal. And here's the bind Japan is stuck in. A weak yen is great for exporters, the heart of Japan's economy, but it makes imports painful. Japan brings in all its oil priced in U.S. dollars. When the yen is weak, every barrel pushes domestic inflation higher. That's a problem Takaichi can't simply fix, not unless she flips her entire fiscal approach, and that's unlikely. After decades battling deflation, Japan finally got inflation above 2% in early 2022. Now it's sitting around 3%. With inflation climbing, the BoJ feels cornered. Stabilizing prices likely means raising rates. BoJ Governor Kazuo Ueda has been hinting at it. He said the central bank will weigh a move from 0.5% to 0.75%. Markets heard one thing: a hike is coming. And as I covered in earlier Geo9 videos, bond yields jumped. Demand for 30-year Japanese bonds hit its highest point since 2019. Yields are brushing levels last seen before the 2007 Lehman era. And right in the middle of this tightening cycle, Takaichi unveiled a giant stimulus package: 21.3 trillion yen, roughly $135 billion. It's the biggest spending plan since the pandemic. It includes cash to offset energy bills, subsidies for households, and one-time payments for kids. It's a strange combination: fiscal stimulus paired with monetary tightening. The goal is obvious: control inflation without crushing households already struggling with higher prices. No surprise, markets don't quite know what to do with this. Normally, higher rates slam growth stocks because borrowing gets pricier, but Japan is seeing the opposite. Investors are treating the potential rate hike as a vote of confidence, as if the BoJ is saying Japan can handle costlier credit. But when you look at Japan's massive debt-to-GDP ratio and the IMF's latest projections, it's hard to see how this signals strength. Now, let's pull the dollar into the picture. Part of the yen's rally isn't about Japan at all. The dollar is weakening fast. The dollar index just logged 11 straight days of losses.
its longest losing streak since 1971. What happened in 1971? Nixon took the U.S. off the gold standard. Moments like this don't come often. With the Fed expected to cut rates, capital is already flowing towards currencies and markets that look steadier, and right now, shockingly, Japan is one of them. Still, the yen is predictable around rate decisions. When the BoJ raised rates for the first time in 17 years last March, the yen actually weakened because Ueda signaled a slow, cautious path forward. And he stuck to that. The BoJ hasn't moved since January. Global turmoil played a role too, especially the ripple effects of President Trump's new tariff policies. This is where the real danger sits. A rate hike isn't just about inflation. It's about confidence. Move too fast and Japan risks sliding back into stagnation. Move too slow and the yen could crater again, sending energy prices up and pushing inflation higher. It's a razor-thin balancing act. And making a call right now is brutal with so many fast-moving variables. As the December 18th, 19th BoJ meeting approaches, the spotlight is squarely on Tokyo, not just for Japan's future, but for global markets. The BoJ isn't just deciding the fate of the yen. Its next move could reshape Japan's path and send ripples through global bonds, stocks, and currencies. Stay close. Something big is building in Tokyo, and when it hits, the shockwaves won't stop at Japan's borders. They'll be felt across the global economy. Hope this breakdown on Geo9 helped clear the picture. Drop your questions in the comments. Thanks for watching.